Hello, everybody. I'm Fabi from The Next Big Rush, and I'm here with a very special guest, Jay. He's speaking from Hong Kong, and he has a very interesting story, which you will hear about in this interview. Now, we're going to be talking about investing in general, about mining stocks, about the ugly side of mining stocks, and some mistakes that you should be avoiding for sure if you don't want to lose your shirt. Jay, welcome. Where are you speaking from right now?
I'm in Hong Kong. It's the New Territories. It's a place called Toon Moon. I had actually never even heard about it.
Hmm.
I actually have an auntie. She owns an apartment out here, and as some of your listeners, maybe if they're familiar with my background, I've been kind of on this path of investing and trying to save up money because I wanted to travel the world. And I finally pulled the plug on my corporate job earlier this year, and just kind of out on a whim, I was like, I want to kind of leave the States a little bit and kind of see the world, grow as a person, just have some new experiences. So it was kind of like basically looking at a map of the world and just picking some random location. It was kind of like flipping a coin, if you will. I'd never been to Hong Kong, and when I found out my auntie had kind of a vacant apartment here, I said, sure, why not?
For sure. Look, I'm not even going to try to pronounce the place where you are right now because I'm pretty sure that my Asian language skills are not up to scratch. But tell us a little bit about why you became interested in saving and investing in the first place. Because you look like a really young guy, and I'm not going to spoil the story because I follow your blog, so there's a lot of stuff I already know. But for those people watching you for the first time, where did this come from? Were you like born with the right saving genes where you were just prone to saving and investing? Were you like a little Warren Buffett when you were a kid or what?
That's high praise. Well, thank you for kind of following the journey along and all the support. I would just say, for the most part, my childhood growing up, it was no different than anybody else's. I mean, when you're young, you just kind of want to play with toys, right? In a sense, maybe I started working a little earlier than most. I got my first job at 14, right? And it wasn't a paycheck. I actually used to get paid in tips because I bagged groceries for the commissary, which is kind of for the military families, and they paid out in tips. And it was like the greatest feeling in the world where you walk in, and then like you walk out the same day, and it's like, hey, I have $50 to my name, and well, I didn't have to pay tax, so it was really cool. And then as a kid, you just start spending. I was buying like video games. It's kind of, I guess, good if you learn earlier than later, because I think a lot of people have that experience maybe in their 20s, but I kind of experienced it when I was 14, 15, where after you save for a while and then you buy all these toys, you go to work the next day, you come home, and you're like, wow, I really haven't saved anything. And it's been like, I've been working for 6 months or a year, and what do I have to show for it, right? And for me, I guess it helped that I accumulated a lot of, quote unquote junk that only depreciated in value. So you have all these like toys, DVDs, video games, and soon enough you're like, well, I don't really want to play this game anymore, and nobody wants to buy it off me, and I can only get maybe I don't know, 10 cents on the dollar or something for it. And then you're kind of like, I don't know, maybe there's something, a better path. Maybe I could be a little more productive. And then, my background is I kind of came from a poor family. So, they really stressed that whole savings kind of matrix where if you want a better life, you got to, work hard, save money, all that stuff. And I wasn't taken to that at first, but after enough times, because I worked there for 4 years throughout high school, and by the time I graduated high school, maybe I had like a few $1,000s or something to my name, so that felt pretty good. Then I learned really quickly, like, oh, I could have done so much better, right? And had I known about precious metals, that's where all my money would have went to.
Okay, but tell me, what age were you when you made your first quote unquote investment, and what was it?
Let's see. First investment was first real investment. I guess was 2006. I was still in college, but I had saved money again from working as a bagger of groceries. My brother, he had started working full time, and he discovered this neat little thing called the Roth IRA. So I was like, ah, sounds so fancy. Like I don't know if I want to do it. I'm probably just gonna lose my money and get scammed. But he was like, no, no, everybody at work's doing it, and I'm doing it. So just put in a little bit. So I put in like $3,000 in a Roth IRA, 2006. By the time 2009 rolled around, it probably lost half its value. And I was like, I don't understand how investing works. The pieces still had not connected at all, but I was just kind of learning as best I could to just play that patience game, because when everybody and older people like your brother are telling you it's going to pay off, just be patient. And I'm like, I'm just not going to look at it, and it'll probably make the whole process easier because every time I look at it, it just defies all intuition because I'm like, why does this thing keep dropping? These early lessons, I think, help you later, especially for a sector like mining, which I'm sure we'll get into later. When you see these sharp spikes in volatility, if you have that experience under your belt, you're more, inclined to just kind of ride it out because you kind of know, fundamentals, that should be the main focus, not so much day-to-day price action.
True, true. And I think we're going through sort of a take a breather moment in the mining stocks right now, thank God, because I was sort of getting worried they were going up too fast.
It's healthy, right?
It is, it is. You need that, otherwise you get a blow off top, and then next thing you know, things crash really fast. But after you made that investment, then did you start to just buy more stocks? Did you buy into the S&P? Like, what did you do after that sort of 2008, 2009?
Okay, so what happened was, with the Roth IRA, I was invested in that, and I just kind of let that go on autopilot. Since I was still in school, I was more focused on, just what, everybody tells you, right? Go to school, get an education, graduate, get a job, all that stuff. I got my first real job. It was an internship in 2007, and it was in the field that I ultimately ended up working in throughout my career. And at the time, I was still so focused on my career, I wasn't really thinking too much about investing. But I'll never forget 2008 because I had saved money. For the most part, it was still in a bank account. But during that period of time, it was okay because they actually paid this thing called interest. By the end of the month, I'd be getting $50 or $100, like just in interest payments. And when you have that going for you, you're kind of less inclined to just go take risks or do like stocks or something that, like, for me, I didn't have the knowledge or the training or the background or anything. So I was like, well, I'm making $100 a month in my bank account. Like, I could be doing worse, I guess.
Free money.
Well, that's how I looked at it. By the fall of 2008, when the whole Lehman Brothers thing happened and the markets just, kind of cratered, that's a moment I'll never forget. And I try to emphasize this a lot in my writing and the blogs because I think, in investing, there's like the extremes where you have fear and greed. No matter how great greed is, there's nothing like fear. I've never seen anything as like devastating as fear. It sounds really, depressing, but I think, you have to look at it from life lesson kind of point of view. Like, what can you really take out of this? And I saw all these like really senior coworkers, and they were just devastated. The key takeaway I get from all this, looking back, was in that moment of fear, it's so paralyzing that even when you have assets like stocks or real estate or, mining shares or anything, that they just, because of all the stress and, like the craziness that's going on in the markets, they will be so far like oversold to the point of, it's just like ridiculous. If you know how to look at valuations and like fundamentals, like there's no reason for you to be scared. So I remember when Apple was like $100 and the first iPhone had released and all that, and everybody's like, yeah, this is the stock of the future. You have to own it. It's going to do really well. But the same people later on would say, no, don't buy it. Don't buy Apple. Especially the financials, like they were the most toxic, right? When Bank of America was like, I don't know, like a $2 stock or something. Everybody's like, stay away, stay away. And it was just like all this fear was so overwhelming. I just kept dollar cost averaging because I listened to my smart brother, who was older and knew what he was doing. So I did all that. And then, with the benefit of hindsight now, it all worked out. I didn't have the conviction or the knowledge or any of that to kind of bet big on any of the other stocks or sectors that were kind of decimated in 2009. But even then, I saw firsthand what can happen when you buy at the depths of despair. That's what I like to call it, which is basically market bottoms. Doesn't matter what asset class you're looking at. If you can buy at the bottom, you're extracting what I call deep value as well, deep value investing. And that, to me, just from my life experience, that's where the bulk of my returns have been made. Is you buy in a period of just absolute fear and despair. Everybody you talk to, even if they don't know the sector, they're like, I wouldn't buy it if I were you. It's just going to keep, dropping more and more and more.
And it's funny because you need to have the psychology of somebody who's willing to go against the grain. And speaking of going against the grain, I want to get into when you got into the mining stocks a little bit later, because then you decided to blog about your journey. Why did you decide to put so much information out there to the world? Like, people can go in and see, like, sort of close to your net worth and all your stocks and all the money going up and down. I mean, when you do something like that, you're open to criticism, right? I mean, how was that decision made for you?
That decision, made for me was a consequence of basically, I reached kind of an inflection point in 2011. I had, I had taken on this new job. It was in Newport Beach. If anybody knows where that is, it's Orange County in Southern California. It's probably one of the most like drop dead, most beautiful places in the world. Like, all the stereotypes that you get, from like Hollywood or whatever, from, the beauty of California. Because a lot of people just make this assumption that California is all beaches and sunshine.
Mm-hmm.
I was born and raised in San Jose, so Northern California, but I'm like, no, that's not really true. That only applies to Southern California. But, when I moved out there, I got to see firsthand. I was like, wow, this is really an incredible place. I was working longer hours than ever before. I had a boss that wanted us to come in on weekends sometimes, to make good impressions for the customer, because sometimes, I don't know, they had like executives that were staying, at our headquarters, and I don't know, for whatever reason, they felt the need to just see what you guys are doing on Saturday, because I guess maybe in the Asian countries, a lot of the manufacturing, all that stuff, it runs kind of 24/7, so they kind of naturally assume, for whatever reason, oh, these guys have nothing better to do. The beaches aren't that nice, so they're going to want to be in the lab, right? The straw that broke the camel's back was one Saturday I had made plans with friends. We were going to go to Newport Beach and just kind of just chill out. And I was getting ready to go, and then I get a text message from my boss. And then I was like, I'm not going to answer that, because I'm about to walk out the door. So then, before I get out the front door of the apartment I was in, he actually calls me. He's like, how come you're not, answering my texts? It's like the customer's here, and we want to make a good impression, so I need the whole team to be there. But then I kind of realized at that time, I was like,
Wow.
but the work I'm doing is not applicable, because, the team member that you need, go invite him, because the customer is going to want to deal with him. He's the guy who's doing, that part of the project. I'm doing something totally unrelated. He's not going to care. What happened was, for me, it was really insulting. I probably shouldn't have taken it the wrong way for whatever reason I did. He basically said to the whole team, it's okay. It's not the end of the world. You guys can come here and just work for, 4 or 5 hours. But to make it worth your while, I'll let you order pizza. I was in a way insulted, because I was like, you're talking to like 20, 30, 40, 50-year-old adults, and you're kind of making this offer like you would to like a little kid or something. Like, we don't have anything better to do. We'd rather sit around eating pizza. So at that point, it's just these little things. They add up over time, where you reach this point where you're like, I don't know if this is the lifestyle I want. By Thanksgiving weekend, I just kind of had this epiphany kind of thing, because I flew home to the Bay Area for, to meet up with family Thanksgiving holiday. And, I just was looking out the window. It was a very empty flight, good time for reflection. And then I was just like, I think there's more to life, right? And then at that time, I stumbled on these blogs that were preaching kind of this whole topic of early retirement. The ones that I discovered were Early Retirement Extreme by Jacob Fisker, and Retire by 40 by Joe Udo. And those were kind of my inspirations. Once I stumbled on, those blogs, to me, it was like taking the red pill in the Matrix, where, okay, like, teach me, educate me. Like, I don't know anything about freedom or financial independence, but obviously investing is like a necessity to get there. Working 9 to 5 for somebody else is probably not the best and most efficient use of time. So that's kind of when I started deep diving into that stuff. And I started the blog in 2012, kind of just to chronicle, time capsule, like everything I was doing. Around the time when I was doing it, dividend growth investing was probably the most popular mechanism that people were using to kind of create this passive income stream. So that's the path that I naturally started on. It was the path of least resistance, and it's been over 4 years since. And right now I'm really big on mining stocks. And when I first started, I never ever could have predicted that I would eventually go down that route.
When you made that change, what was it like? Because I'm assuming that you had followers and you had probably buddies that were blogging about the same topics, and like, what was their reaction?
Yeah, so around that time, I didn't even know the mining space really existed until 2015.
You're a lucky son of a gun.
Market timing, right? Just pure double luck, no skill at all. So that's one thing I try to also like harp on the blog is it's not really so much like brains or intelligence or all that stuff, right? A lot of it is just being at the right place at the right time. That to me, that's really important. So what happened was I was big on dividend stocks probably until 2013, and then I kind of switched over to real estate. I lived in a really hot market, Bay Area for real estate. So, I was just doing the math, running the numbers. To me, it made more sense to pursue real estate because I just saw, I guess, more potential, not only in terms of passive income cash flow, but you had like this ridiculous amount of appreciation. So, I had these dividend stocks and, they were doing well. I don't know if they were beating like, the S&P 500 or the major indexes, but, I don't know. Everybody was making money, but I got big into real estate, so I did that for a while, and over time, you could kind of see the returns were dwindling. And this is the beauty of real estate, because for the most part, people don't buy homes without using leverage or debt. So you have to take on a loan in order to buy real estate. Real estate's usually pretty pricey. But the good thing about debt is it keeps you on your toes, because all the investors that I ever met who got burned in real estate, they all say the same thing. I got way too complacent at the top. I got filled, my ego got too big. I kept chasing after more and more deals, and then the next thing you know, the sector goes bust or whatever, and then it's like dominoes, right? Like one goes bad, and then you have all these other loans, and a lot of people were doing ARMs, so the rates were resetting, and the payments were going up, and then not only that, but prices were going down, so all this equity that they thought they had just disappeared overnight. Their cash flow was almost break even, so they got too aggressive. They kept doing like cash out refis, and when you ask somebody how did you fail or what did you learn, it was always, man, I don't care what anyone says. Like you have to be cognizant of where we are in the market. Buying anything at all-time highs is usually not a recipe for prolonged continued success. So I took all that to heart. So in 2015, I had won my last property. It was a partnership deal. We won in I forget the exact number, it was like the mid $400,000 range. It was a townhouse, right? And I felt pretty good about the deal because it's still cash flow positive with kind of a conventional down payment, which in the States is about like, 20% or 25% or something. So it's still cash flow. So, I thought the deal was still worth pursuing. But 3 months after we had won the deal, prices went up like $50,000 to $60,000. That's like that's just the sales price of the house. It was up like 50, 60,000. But when you look at your leverage return, it goes up even more because you didn't put in that much capital. I think I only put in like I don't even remember, like 15,000 or something. But nevertheless, it's the one thing I always emphasize. Again, you don't fall in love with your investments, and you always have to be grounded. Like just because you're making money, it doesn't mean you should keep doing it. Like the entry points are very important; they matter. Again, especially with leverage. So when I saw that, I was like, wow, these markets are getting really out of hand. Like you can kind of feel. I didn't know if it was a blow off top at that point, but it just kind of felt like it was heading in that direction. And then 2 months after that, I think one of my best friends, he won another similar property, and he had to pay like 80 or 90,000 more than what I was paying.
Wow.
I just said, okay, time out. I don't want to do this anymore. Like, even if real estate keeps running from here, I at that point I had already so much invested. I think I had like over $1 million in debt already. Like I was just convinced there are more than one asset classes out there. At the time, so I was really kind of, I reached the point of basically I knew I didn't want to do real estate anymore, but I didn't know what I wanted to do. So basically, I took a time out from investing. I was holding a lot of cash. Actually, just to clarify, what I did was I did some cash out refis earlier in the year. So I pulled out a lot of money. Initially, I put it back into dividend stocks. But then I got scared of that market too, because the S&P 500 was, I think last year it set the record high in May of 2015. For a while, I was so convinced in the strategy of buy and hold forever that I thought, oh, even if I'm buying at record highs, if you extrapolate time, on the x-axis far enough, eventually it'll all work out and I'll make money. I don't know if this is the market top, but I know it's not the market bottom, right? So I use that rationale to I basically actually at that point in the summer of 15, I got kind of crazy. This is when I lost the majority of my readers that had followed me along from the very beginning. Because I announced on the blog, I'm getting out of stocks. Like I sold out of my 401k completely. I cashed out of my Roth IRA. I held no equities, and I had all the cash that I refied out. The rent appreciation had gone up so much, I could refi and still be cash flow positive. One thing I've learned just from studying market cycles is in a market bottom, the biggest regret most any investor has is I didn't have cash. At that point, summer 15, I was just holding cash. I didn't know what to do. I was in limbo. Mm-hmm. But I was okay. I kind of told myself I'm willing to be patient because I think an opportunity will present itself at some point. I don't even remember how I stumbled on mining stocks, but I think it was through YouTube, and probably the best thing that ever happened to me.
Yeah, if there's anything to be said about luck and timing, this is it. This is the greatest example because you really got in at pretty much the bottom, right? I mean, in hindsight, of course, we look at it as the bottom now, but as you bought, you must have looked at those charts and thought, my goodness, all these companies were like $10 and now they're like $2. And some of these are supposed to be, decent producing gold miners. Obviously, some of these are, lesser known, riskier projects. They don't know if the gold is there. They don't know how much gold there is, but you can sort of gauge what the price used to be like at the top in 2011 and think, what the heck? Like, what made you think, okay, I'm going for this? Because you had quite a bit of cash in your hand to invest. What made you take the jump and say, yes, I am buying these crappy little mining stocks at what looks to be the bottom, and let's hope it is.
Yeah, it's so crazy because the reality of it is it was only about a year ago, right? But like everything that's happened this year, it just makes it seem like it was decades ago or something. But the craziest thing is exactly what you said. In September, I posted an article. It was called Deep Value Investing. I'm like going full steam ahead with this whole gold trade. And that's exactly what happened was, I was studying these miners. And at that point, I really knew nothing about the industry. Like I didn't know, like, I remember you and Nick talking, Mining Book Guy, in the last video, about like all the different, like subsectors of gold investing. Like you have prospect generators, you have early stage exploration, development stage, mid-tier producers, senior producers, and it's kind of a lot of options. But at the time when you're first starting, it's like the first name you stumble on, what is it? It's going to be Barrick Gold, right? That's kind of by default.
The big one.
The big ones, right? So I was looking at Barrick Gold, Newmont Mining, Goldcorp, and probably the GLD, ETF, and GDX and GDXJ, right? So you see all this and you're like, I don't know how to decipher them because like, should I buy an index fund or, should I buy the individual miners? So my first business of, research was just to kind of see what the difference of these products are. So I guess, you start doing Google searches like, GLD ETF. And it wasn't, before long when you read all these articles or comments and people are like, no, don't touch GLD. It's not backed by physical gold. It's just a paper product. It's like a game of musical chairs or something. But that kind of leads you to these rabbit holes, that kind of take you to alternative media sites and, I don't know, quote unquote gold bugs, if you will, or whatever. And then you kind of learn the monetary history and the whole rationale behind investing in gold. But, without even diving into those details, when you start looking at these producers, and like one that I cited was like Kinross Gold, right? I didn't know anything about it. But I saw that it was like this, I forget, it was like $18 stock or something. And then in September when I wrote the article, it had fallen to $1.80, or I think at that point it was even $1.50. It had dropped momentarily, it came back up. And I was like, I don't know anything about gold mining stocks, right? But when you fall that drastically, you have to pay attention, right? I mean, because everybody, I don't really understand because like when you first start investing, the first thing you learn is buy low and sell high, right? So when I saw these charts, if it was just Kinross Gold that was down, but Barrick's was like at all-time highs and Newmont was high, then I'd be like, okay, this company is just screwed up. I'm not going to buy it. But when you put all these charts and you overlay them, right, and the indexes themselves, I think to me that's like a clear signal, from the markets. It's like this is not micro investing, this is macro investing. The entire sector is in liquidation.
Deep liquidation.
It doesn't really matter which chart you look at; they all coincide. They're all minus 80%, 90%. So I started doing research and I was like, okay, a company like Kinross Gold, okay, they have a lot of debt, but it's a real producer. it wasn't like somebody who's sitting on, they like to say moose pasture. Maybe they'll find something, maybe they won't, so we're just going to try to find some suckers to get into this, hype story. It was like, wow, it's a real producer. It's like a 1,000,000 ounce a year producer. And it's just like sitting at all-time lows, right? And then I discovered certain other charts like the HUI to the physical gold ratio. And again, these are all macro indicators. It doesn't take any brains. You just have to be willing to look at these macro charts, right? And then I looked at it and I was like, wow, record low. Like it's never been this low before. I'm a guy who's a big fan of opportunity. I made the bulk of my returns through real estate because I was buying at a time when nobody cared to buy real estate. I remember all the conversations with my coworkers during lunch, right? And they're like, no, don't buy real estate. It's going to fall farther and farther and farther because that's just the sentiment at the market bottoms, right? So again, like the whole 2008 thing, I just never forgot it. I was like, okay, I don't know anything about gold and silver. But, I felt confident in the sense where I knew that I wasn't investing in some like, Kodak film or coal or, some kind of asset or commodity that's being phased out and the world doesn't want it anymore. Maybe it's kind of my family's background history as well. Like we've always kind of, I wouldn't say we revered gold, but we never looked at it from, the point of view where, oh, it's just a barber's relic. So when you start getting into any sector, and it was no different for me when I did dividend stocks or real estate, you have to get educated. One thing that I like to always emphasize on the blog is don't assume you know something when you really don't. Like, I don't know anything about tech stocks. And when I was younger, I used to make all these assumptions, right? Like companies like Facebook or something. And they were dumb because looking back, I'm like, I'm not even in the right place to be putting a valuation on a company like Facebook, right? But going back to just gold stocks, I was like, okay, I am interested in the sector because it's so hated and it's so much in liquidation, but I don't know anything about it, right? So I need to research this. So I started spending basically day and night just like trying to digest this information, At first, you don't know what the right sources are, but then, somehow I lucked out. Maybe I listened to like one of the Sprott, YouTube videos or something, and then you figure out guys like Eric Sprott, Rick Rule, Ross Beatty, kind of like the legends in mining.
The newbies, they don't really know what they're saying ever, so you shouldn't really follow them.
First, it was like, okay, whatever. I'm just gonna listen to a bunch of sources and see if something sparks an interest or it passes through a filter or something. And Rick Rule in particular is a guy that I could listen to like all day long. Just the things he says and kind of the stance he takes. For anyone who's just getting started in mining, I mean, I'm not trying to like push like to go invest with Sprott Global or whatever, but it was a very it was a wealth of information for somebody like me who was new to the sector, didn't understand anything about it, to listen to a guy like Rick Rule, because you can just hear when he talks, like this is a man who's speaking from decades of experience. Like he's been through market tops and bottoms. He knows the investor psychology, just basically what happens, from those extremes. And, just listening to the guy talk, it was like, I'm not afraid of bear market bottoms. Like if anything, I'm going to keep investing and try to get in the best names, because I know the sector will turn again. And then, he had these stories about like when he invested in uranium and, 10-cent stock goes to a penny. But if you're right on the fundamentals and you're investing in a commodity that's not going obsolete, at some point the sector will turn. And he had this saying where, I have so much patience, I could watch paint dry on the wall. So when you hear things like that, you have more conviction. When I first started, I really didn't put that much money in. Maybe I put like, 10,000, 20,000. But as the months progressed in 15, the stocks just went in one direction. It was just like down, 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 down.
How did you feel then? Because you had just made this huge move and the stocks weren't taking off like it's supposed to do, and all the infomercials.
I didn't know when it would take off, but I was just looking at these valuation metrics. Again, I'm no expert or whatever. I try to look more macro kind of view. But when you're looking at people like price to earnings, well, these miners had no earnings, but price to book value, enterprise values, and like some companies had more cash in the bank than their market cap value. I wrote an article about that. I was just like scratching my head, like how is this even possible? It doesn't make sense. It's like your land is worth less than nothing. Okay, just roll with it, right? And then I was seeing like just historically like what an enterprise value to like ounces in the ground or production, what those numbers should be, and where these stocks were trading at. And the cheaper they got, I'll be perfectly honest, like I just was even more interested. Like it only elicited a stronger response from me. And it's all like chronicled in my blog, like around October until January 19th. You could just follow like all the purchases that I made. It's all documented on the blog, and you could see every time that I just kept adding and adding to these positions because I didn't care if they kept going lower because they got to the point when like I think Rick Rule says it's like buying a dollar for 10 cents. Like
no brainer.
the answer is yes, right? If you could buy a dollar for 10 cents, you just say yes. You don't ask questions. You don't care what other people are doing, right? And if you look through the comments and kind of the sentiment from these posts that I was making, it's like a lot of people are like, I don't know if I have your conviction, or I think prices are just going to keep dropping. And then you have like, there was this new article. It was like gold. Let's be honest, gold is a pet rock, right? When I saw that article, I was like, I got to buy more.
I remember that.
I got to like double dip or triple dip or something, because that's exactly the sentiment that I needed. Because I was like, you need the whole macro view from anybody who's not in the sector, who's not in the space, to be that bearish and that negative. To me, that's a sign to buy.
And that's maybe a tip for some people who maybe just haven't had the experience yet that you've had of going against the grain. When you buy something and you make it public, whether it's speaking to friends, family, people at work, or people who follow your content around finance and wealth building, I guess, if everybody agrees with you, there's something wrong, because that means it's probably front page news. It's probably the story everybody's talking about. It's probably, S&P 500 at all-time high, so obviously you should buy it. So it's a great contrarian indicator. Be very, very worried if you're coming out saying that you're purchasing something, you're investing in something, and nobody disagrees with you. That's not a good sign.
A good indicator probably to start selling. It's funny because when you look at all these markets, it doesn't matter what asset you trade. It's usually, what I've learned is, okay, I'm a retail investor. I have no advantage over anybody else. I have no inside information. My family background is not mining. It's like, if you think intuition and logic, it basically says big money is always going to move in before they tell anybody, and big money will exit out before anybody knows, right? So when is it the best opportunity to exit out? When you start running these front page stories about why gold's going to $10,000 and these mining stocks are gonna, 10x from even where we are now or something. I mean, when that's prevalent, and your best friend is into gold stocks and your coworkers are buying gold stocks.
When they're asking you for advice, right?
Because I'll tell you, like, to be honest, like when I was doing this trade, there were a few people I was talking to that were really big on gold stocks. Like, they didn't care what the mainstream was saying. And I'm just gonna put a plug out for Mining Book Guy and Nick, because he's really great guy, and he's one of the few guys that I met last year that had so much conviction. Like, we used to have these conversations in private, like around like November timeframe. We used to joke like, we should just record these conversations because nobody's going to believe us after, it.
I wish you would have.
But the sector turned way too soon. We always thought we had like a lot more time, because I didn't know. I thought maybe we had another 2 years of kind of the, this bottoming out process. But, it was very evident to me, because I talked to some other friends or coworkers, and they'd be like, I hear you. I mean, I really hear you. I could see the charts, and, I can add like 2 + 2, like I can see it, but they're like, I just can't do it. Like, for whatever reason, I just can't pull the trigger. So again, it's just like kind of putting all these data points together. For me, it's like, okay, when people are gun shy, it's probably a good time to buy right now. And I'm not trying to rip on anybody or anything like that, because it's very hard to buy at the market bottom. I'm not going to lie and say that it's easy. It's very, very difficult seeing your portfolio down 30% after you just made a purchase like 2 weeks ago, right? But at the same sense, if you're cognizant of these things, then you have to realize when all your friends are getting interested, and definitely like the sentiment has changed where a lot more readers and friends and family, like for me, like they're just getting interested in the sector now. Granted, I think we're just starting the recovery. I think we still have ways to go, but when you have this change of the landscape, then you kind of know when you're exiting out of the bear market. Like right now, I think without question, we're not in that depths of the bear market anymore. The sector has turned, like it's rallying. You can really see it too, because when gold pulls back, like let's say silver's down 2% or something, gold's down 1%, the stocks like barely move. yesterday or today, I guess, in the States and in Canada, for example, I thought it was really interesting. A company like Bear Creek was up like almost 10%, and silver had pulled back 2%. To me, that was like that doesn't happen. Like, what's the deal with it?
It's not supposed to, right?
Last year, just in contrast, there'd be days I remember when gold and silver were up, let's say 0.5%, and the stocks were down 9%. That's kind of the territory that I'm familiar with, and this is how you gauge market tops and bottoms, right? And I think it's all hindsight now, but just kind of for future references, if you will, the best time to buy is when logic doesn't make sense in that direction, where like let's say the underlying commodity is going up 3 days in a row and the stocks are going down, more and more and more. Like to me, it's a good indicator. Like keep that in your back pocket for future use.
Great. So you really, like I say, in order to sell high, you got to buy low. If you buy high, there's no point. You're just really putting yourself at risk, unless you're trading, in which in that case it's a completely different ball game. And
you need to find the next sucker to offload your shares to when you buy high.
Exactly. And when you're speculating, you're always really thinking about how is this going to look more valuable in the future. Not just will it actually be more valuable, but will people know about it? Will people be excited enough to bid up the price? And then you can sell it for a profit. But then you have to sell it. There's no point in holding on to your beloved stocks as if they were your little pets. Talk to me about that. What do you think happens in people's brains when when they hold a stock up into all-time highs and then just see it collapse or just see it slowly fade away? Like, tell me a little bit about that.
In my personal opinion, it's either one or two things. It's either you get complacent to the point where, because you're up so much, let's say you're up 500%, then you don't really want to monitor it every day, because in the back of your mind, it's like, I have so much cushion, the stock could half in value and I'll still be sitting pretty. So you kind of just stop paying attention to it. The other one I think is also, from what I saw with real estate, is a lot of hubris sets in at the top because you think you're better than you are. Everybody likes, I don't know, not everybody, but it's just human nature. You want to like pound your chest and be like, I'm so good. I'm so much smarter than everybody else. And, nobody saw this, but I did. And I don't know, you just like, you just want to be even more aggressive because it's the confirmation bias. When your best idea has worked out so well, it's natural that you think the same idea can be churned over and over and over again. I always keep in mind, like, I try my best to be grounded in the sense where if my best idea works out, that's the first idea I want to get out of, right? Because the bulk of the gains, the bulk of the returns have already been made, right? There's less alpha to extract. Like, if anything, I should start looking for other asset classes, right? The approach I took with real estate is the same approach that I will take with these mining stocks. There will come a point in time when I'll probably be able to value it relative to other asset classes, and I'll be like, wow, these mining stocks can buy me so many shares of the S&P or, emerging markets, or, I don't know. The thing is, nobody has a crystal ball. You can't know which asset class will be hated next, right? But these market distortions and opportunities just always tend to happen. I don't think in 2011 anybody would have foresaw this commodities collapse, right? I mean, but it just happened, and then when it does, you have to remember kind of what you're doing. My blog it's not a dividend blog. It's not a real estate blog. It's not an index investing blog. It's a financial independence blog. I think that's the common ground that relates everybody. It brings, everybody's journey for investing is really the fundamental goal is financial independence, where, you can basically have enough, cash flow or passive income coming in every month where you don't even need to work anymore. You could work if you love it and you enjoy it, but that freedom is basically why you invest, right?
I completely agree with you. And still on that topic that you just mentioned, what are you looking for, investment-wise right now? Like, you've had these gains in gold. Are you looking to pull out? Do you think there's still a long ways to go? Are you looking at maybe different resources or different types of investments?
Yeah, with gold and silver, I bought a good amount of allocation for myself. I guess, when something goes up, you always say, I wish I had more. It's never enough. But I did start trimming some positions just to reduce the cost basis. Like I try to just really cut down my cost basis, and just to kind of create more of a hedge position. One sector that I was starting to study up and I liked a lot was lithium and kind of the whole clean energy movement. Granted, that one I think will take a bit longer to play out. But I'm patient. Again, it's like when I form an investment thesis, I don't need it to work out right away. I mean, if it takes 3 to 5 years, then that's fine. Like for me to just sit back and wait. But I try to take the knowledge that I gained from gold stocks to apply it to these other sectors because, like lithium, for example, there's a lot of junior exploration plays which have a market cap of under 100 million, but they're onto major discoveries. If lithium takes off, I don't know, half, it does half what I think it will, just potential wise. And, I think that's a sector that could really work out for investors just because, I think it's without shadow of a doubt right now, this whole Tesla movement, Model 3, you have all these major car companies now, like for example, like Mercedes and Volkswagen. No matter which source you look at, it's basically compounded annual growth rate for electric vehicles is going to be in the double digits. Lithium got bid up in March, and the Tesla hype reached kind of this short-term fever pitch. And
I was just gonna ask you that. What do you say to people who maybe think, well, lithium's already gone up and some stocks have crashed really hard? Like maybe it's over.
That's too. I mean, I look at it from a macro perspective. I think to say it's over is a bit premature because what has changed from March till now? Basically, Model 3 from Tesla got unveiled, and then it went silent because the car is not going to be in mass production until 2018, and we're only in 2016. So to say that the story has fizzled out, to me, it doesn't make sense. It's like saying iPhone or Apple is going to announce the first iPhone back in 2006 or something, and then by early 2007, before it even ships the first unit, people are saying, "Oh, that's the end of smartphones." Of course, I could be, wrong. I don't work in the industry. I'm just a retail investor. I take the data that's available to me and I try to process it.
Great. You have so much interesting stuff on your blog that I cannot leave this interview without letting my viewers into a little bit of your day-to-day life, so to speak. I mean, you don't blog every day, and poor you, I mean, you have other stuff to do rather than, just writing all day. Writing is a very taxing activity, but you have a lot of great information on your blog, and people can just learn like an MBA's worth of stuff by reading your blog. And I'm speaking in truth because you go into such detail that really just pulls the reader in, and just you have a lot of lessons in your writing that should not go unnoticed. And so I want my viewers to go to your blog and sign up to it and follow all your stuff. Where do they go?
Well, first off, I should just say I really appreciate the kind words. To me, it's very humbling and flattering when somebody reads the blog and they're like, "Oh, you have something interesting to say, and I want to follow along." I mean, when I first started, I didn't even think I would ever have like one subscriber. It was more of a journal, just talking to myself kind of thing. So, it's just it's been kind of a surreal experience. So I'm just really happy and appreciative of anybody who reads the blog and has interest in following along. The blog is fifighter.com. F is for financial, I is for independence. So financial independence fighter, fifighter.com. And it's not, again, it's not a mining blog, it's not a real estate blog, it's not a dividend blog. It's more of a just life blog. I kind of write about whatever and anything, but I do have a strong interest and passion for kind of deep value kind of investment opportunities. I'm seeing a lot of opportunities in gold, silver, precious metals, and other commodities. So for the foreseeable future, it'll probably be an emphasis on the blog. But just kind of FYI warning any future readers right now. I've been known to kind of change with the seasons. So
that's what's so interesting, is that because you're not tied up to one particular investment vehicle, you can sort of bring in something new, bring in fresh ideas. Make us sort of question, hey, is this maybe an opportunity? Is this where the world is going? Is that undervalued, or is it worth taking a look at? And we need people like you. I mean, I've been following a lot of people who are just buy gold, buy gold, buy gold, and it seems like they don't have anything more to say, which I understand. Like, once you really grasp economics and the current economical system that we have in the world right now, it's kind of difficult to forget about the whole gold and silver story. But at the same time, there are billions to trillions of dollars being exchanged while you're just into that one sector, that you'd be a fool not to look to the side and see what else is there. So thank you so much, Jay. This has been wonderful. I'm sure there are so many golden nuggets on this interview that people are going to for sure love it, and like it, subscribe, and share it. Thank you so much. We'll probably have to do this again because I'm pretty sure there's going to be a lot of questions and other interesting things that people like to know about you. But we'll catch you soon for sure. Thank you, Jay.
Thank you so much, guys.